It's amazing to think that it's already been 3 months since Facebook completed its IPO and started trading, since so much has happened since then. The first 3 months have been very disappointing for the share price, with it falling over almost about 50% from its opening trade. However, it's not the only major technology IPO to struggle in its first year of trading. Google, which has been seen as the gold standard for 21st century tech IPOs, has turned out to actually be not only has its performance been exceptional, but it actually has been the exception rather than the rule. Some of the previous IPOs have seen weakness as well following the end of quarterly anniversaries. And this is because some shares, especially those held by private shareholders, initially are locked up or prohibited from trading when the company initially goes public. The prohibitions on trading then are lifted as the year progresses, usually at the 3-month, the 6-month, the 9-month, the 12-month, and other such anniversaries. When the prohibitions come off and the shares and the lockups and the shares are then permitted to trade, oftentimes you see an increase of supply in the marketplace as some shareholders then elect to take their money and deploy their capital elsewhere. Because of this, we have seen weakness in some shares, so it's worth noting, and we'll show this again on the next slide, which highlights market performance. Data for all of the charts and tables in this presentation are sourced from CMC Markets and or Bloomberg. So we'll look now at the first year performance of major technology IPOs, and we'll start with Google, which is this blue line here at the top, which showed it had a very strong rally. Then from about week 9 through to about week 36, which is approximately the 2-month to 8 months following the IPO, the stock leveled off and had a nice solid consolidation. Then at around the 35-36 week mark, had another big rally up that ran through about week 44, or around the 9 to 10 month range, had a big rally again, where the share price once again had a huge return. Then it leveled off and finished the year strong. So Google did quite well, but we will note here that the 13-week anniversary and during the 26-week anniversary, when lockups would have come off, the shares were in consolidation mode. Interestingly, when we come down here and we look at this red line and this purple line, the red line is Baidu and the purple line is LinkedIn. And in their cases, they had initial declines. They had a little bit of weakness and through a consolidation through their first quarter. And then this is important from about the 24-26 week range through about 39, or the 6 to 9 month period following their IPOs, they actually were underwater. They actually were trading below their opening price. And following that, though, the shares started to advance and both ended up finishing their year quite strong and being considered an overall success. But even ones that are successful, as you can see, can have their ups and downs. One that's had its downs and downs has been Groupon, which has been consistently underperforming throughout its first year. The company has struggled with its business, it's struggled with its accounting, and because of that, the street has lost confidence. A lot of confidence in the company has been lost over the last 9 months or so since it came public. So far, Facebook's return and performance has actually even been worse than Groupon's to this point in time. This with an initial sell-off, a consolidation, and then another sell-off after its first earnings report. So based on this trading performance so far, it's pretty clear now that Facebook's IPO valuation was quite high and that the deal was perhaps a bit too overhyped and potentially overpriced. Although the company's management has disappointed out the gate, it's important for us to recognize, though, that Facebook's problems are not as severe as the problems that Groupon had. Facebook has not had an accounting scandal or other major issues. It has struggled with its growth, but at the same time, it has avoided some of the problems that Groupon has had that's depressed its stock price. The big drop in Facebook has, however, at the same time as bringing the price down, it's also brought the valuation down. So it's perhaps not trading as expensive as it was, and it's starting to come back more in line with other technology stocks. That being said, based on some measures, it could still have further downside from here. There are still some risks in Facebook. It's not necessarily all done yet. The stock does appear to be attracting some support lately in the $20 to $22.50 range. At this point, it's not as expensive as it was, but it's still not necessarily cheap compared to other technology companies. Should Facebook itself continue to disappoint, however, it is possible that the share price and the valuation could still contract further. So we have to be careful of that. It looks as though it's starting to stabilize, but there is this potential for further weakness. There is a potential for an additional washout before all the weak hands are shaken out. And on this chart here, it looks complex, but it's actually, there's a few areas that we'll focus on in particular. And we're going to look at PE ratios, as the price to earnings ratio being a common guide for how much investors are paying for a company, how many dollars are they willing to pay in share price for $1 of earnings. So if we look at technology companies here, if we look at Apple, and we're going to look, by the way, because markets are forward-looking, we're going to look at the price relative to the forecast earnings for next year, for 2013. So Apple is currently trading about 11.4 times next year's earnings, Google around 12.6%. When Facebook came out, it was trading at about 60 times forward earnings, which was clearly quite pricey. However, since then it's contracted. The PE multiple has come down, and it's now trading closer to 33 times next year's earnings. But when looking at the PE ratio, it's an important thing is it's not quite apples to apples, because different companies have different growth rates, and a general rule of thumb around the street is that investors and traders are willing to pay more for higher growth. Therefore, a higher growth rate could justify a higher price to earnings ratio, all else being equal. So the way we get around this to come up with more of an apples to apples comparison is to divide the PE ratio by the forecast growth rate. By doing that, we get a ratio called the price earnings to growth ratio, or the PEG ratio. The idea being that if you have a company trading at 10 times earnings with a 10% growth rate, that the two of them are equal, and the rule of thumb would suggest that's reasonable value. The two of them being equal would give you a PEG ratio of 1. Similarly, a stock that has a 20 times PE and is growing at 20% a year would also have a PEG ratio of 1. So this helps us to analyze how a stock is performing relative to its forecast growth. So looking at the PEG ratios for 2013, which is in this lower set of rows here and this middle column, we'll find that Facebook was trading at a fairly high 1.9 PEG ratio when it first came public, but now that it's fallen back closer to the $20 level, it's actually trading at a PEG ratio closer to 1, or closer to the general rule of thumb for most industrial companies. Now, that being said, looking at the technology sector in particular, some of the large cap senior tech names actually trade with PEG ratios of less than 1. So if we look here at Apple, it has a ratio of 0.58, Google 0.77, and LinkedIn 0.89. The three of these average out to a PEG ratio of 0.75. And so looking at this now, if we looked at the this next column here, would suggest what would the price be if these stocks were trading at a PEG ratio of 1 based on their 2013 earnings, suggests that that Facebook perhaps could level out around $19.60, which is pretty close to now trading just above the $20 level. On the other hand, if you took used a 0.75 PEG for 2013 for Facebook, it would actually suggest that the value may be more closer to just below the $15 level, around $14.70. So because of that, there is still some room and still some potential downside possibility from here based on valuation. Similarly, now, if we look at the Facebook chart, we'll see that it had a big sell-off initially, but through June and July, it actually consolidated fairly well, trading in the $26 to $33.50 range. It then had a big another sell-off following its disappointing earnings report, and has leveled off in this 1975 to 2250 area. 1975, we'll note, is pretty close to the value on a PEG ratio of 1. So far it's been leveling off and trying to stabilize. However, between lockups and there's the coming off and the risk, of course, of disappointment in further earnings reports, we can't say that the stock has reached a bottom as of yet. There is a potential for weakness. If you did see a breakdown, we'll note that this larger trading range here, $26 to $33.50, its measured move comes in down around $19.50. This more recent trading range, 1975 to 22.50, on a breakdown would measure down technically closer to $17. So there is still a little bit of downside potential in the stock on both the fundamental side as well as the technical side.